Over 1 million people max out their ISA allowance every year. The next decision you make could be the difference between missing out or making thousands of pounds. In this comprehensive guide, I'll show you exactly where to put your money after maxing out your ISA to keep building wealth tax efficiently. Stick around to the end because step 5, if done right, may have the biggest impact of the lot. Let's dive in. Step 1. Pension contributions. Want a 100% return on your initial investment? Pension contributions give you a boost you can't ignore: tax relief, employer top-ups, and long-term growth. Meet Mike. Mike is a 35-year-old professional who just maxed out his ISA. He's now wondering where to invest next. Instead of stopping, he turns to his pension. Mike is a higher rate taxpayer and he wants to contribute £10,000 to his pension. Because of tax relief, this only costs him £6,000. The government adds £4,000. Plus, his employer matches 5% of his salary, adding another £2,500 per year. Over 30 years, assuming 7% annual returns, this single £10,000 contribution could grow to over £76,000. The best part is that up to £60,000 can be contributed to your pension between you and your employer while still receiving tax relief. On top of your £20,000 ISA allowance, this is an excellent start to your annual investing game plan. And if you're married, your household can invest up to £160,000 in this tax-efficient manner. One additional little-known benefit is that if Mike retires abroad, he may benefit from lower tax rates on his withdrawals, maximizing his returns even further. Some countries even offer tax-free pension withdrawals for foreign retirees. Mike met a retired mentor who told him, "I never thought much about my pension until I saw my friend Paul struggle in retirement. That's when I maxed it out. Now, my pension covers my lifestyle without touching my savings." One final pro tip is that if you're self-employed, you can open a SIP or self-invested personal pension for even greater flexibility and investment options to include stocks, exchange-traded funds, bonds, real estate investment trusts, and even commercial property. With flexible withdrawals, you can take 25% tax-free and manage the rest strategically to minimize tax, unlike rigid annuities. Step 2. General investment accounts. Think your investing options end after your ISA? Think again. A general investment account gives you unlimited investing power, as long as you manage tax smartly. Mike still has cash to invest, but has used up his ISA allowance. Instead of keeping it in a low-interest account, he opens a general investment account. Unlike an ISA, capital gains tax and dividend tax apply in a general investment account. Mike invests £50,000 in a diversified index fund, generating £5,000 in capital gains and £1,500 in dividends after 1 year. However, by utilizing the tax minimization strategies, Mike's first £3,000 of capital gains and first £500 of dividends are tax-free. Mike can also utilize spousal tax planning by transferring half of his general investment account to his wife, who pays lower tax rates. Mike's friend, Dave, once ignored tax planning and got hit with a £3,000 tax bill on his general investment account investments. Mike learns from Dave's mistake and spreads his gains over multiple years to stay within tax-free allowances. One final tip is to use a bed and ISA strategy. Each tax year, you can sell assets in your general investment account up to the capital gains tax allowance, then repurchase them inside your ISA up to the ISA allowance, which resets annually. These assets are now safely invested in your tax-free wrapper. Step 3. Investment bonds. But before we start on investment bonds, it's pop quiz time. What's one of the biggest advantages of investing outside of a pension? Is it A, there are less restrictions in accessing your money at any time? B, there are no tax implications? C, it guarantees higher returns? Or D, pensions are only for experienced investors? Leave your answer in the comments section below, and I'll reveal the answer later. The UK's wealthiest families have been using investment bonds for decades to defer tax and build wealth across generations. Here's how you can too. Mike explores onshore and offshore investment bonds, a lesser-known way to grow his wealth tax efficiently. Offshore investment bonds allow tax deferral. You only pay tax when you withdraw funds. Mike invests £100,000 in an offshore bond, growing at 6% per year. After 10 years, his bond has grown to £179,000, but because he hasn't withdrawn, he owes zero tax so far. Alongside this, Mike can benefit from tax slicing. Tax slicing allows Mike to withdraw up to 5% of his original investment per year without immediate tax liability, effectively deferring tax for up to 20 years. If Mike needs larger withdrawals, tax slicing spreads the taxable gain over multiple years, reducing the likelihood of paying higher rate tax. Furthermore, Mike can assign parts of the bond to his children or spouse at a lower tax rate, reducing his overall tax bill. Sid, a wealthy client of Mike, once told him, "I've built a £1 million portfolio using offshore bonds, and my family pays almost no tax on withdrawals thanks to careful planning." That's when Mike realized why the ultra-wealthy use investment bonds. A pro tip here is that, like with pensions, if you plan to retire in a low-tax country, investment bonds can be withdrawn tax-free in certain jurisdictions. Step 4. Property. Property investing can create passive income and long-term wealth, but if done wrong, it can be a financial drain. Let's do it the smart way. Mike decides to diversify into property, but instead of buying a traditional buy-to-let, he chooses a REIT, or real estate investment trust, for liquidity and tax efficiency. But what is a REIT? A REIT is a company that owns, operates, or finances income-generating real estate, such as office buildings, shopping centers, apartments, and warehouses. REITs allow investors to gain exposure to property markets without directly buying or managing real estate. They are structured to pay out at least 90% of their rental profits as dividends, making them a popular choice for income-focused investors. REITs can be publicly traded on stock exchanges, offering liquidity and diversification, or private, with access restricted to institutional or accredited investors. As they can be traded on stock exchanges, it crucially means that they can be held in your ISA, SIP, or general investment account. Let's look at the figures. Mike invests £50,000 in a REIT yielding 5% per year. That's £2,500 in annual income, plus potential capital appreciation. Because REITs are taxed differently, Mike receives his dividends gross, meaning no national insurance deductions. Using a REIT as an alternative strategy to buying a rental property outright, Mike invests through a joint venture with his business partner, Max, leveraging his capital to get higher returns. Mike's colleague, Simon, bought a rental property in 2020, but was hit by higher mortgage rates and taxes. Mike, however, focused on high-yield REITs and doubled his passive income without the headaches of tenants. If, however, you still prefer physical property, look into serviced accommodation, or HMOs, or houses of multiple occupation, for higher yields on your investment. Step 5. Investing in yourself. You are your biggest investment. If you don't invest in yourself, you're capping your earning potential. Mike realizes that his investments are growing, but his income is staying the same. So, he decides to invest in himself. After maxing his ISA for the year, Mike puts aside money every month to self-finance a low startup cost side hustle. Mike could start a channel on YouTube based on his interests and passions, generating £2,000 per month in passive income. He could spend £1,000 on an options trading course and earn £5,000 from his first trade. He could learn a new skill online like copywriting, coding, digital marketing, or video editing. This would allow him to start freelancing, consulting, or launching a service-based business, creating an income stream with minimal upfront cost. Unlike stocks or property, when invested outside an ISA or a pension, investing in yourself has no capital gains tax. While you'll pay tax on side hustle income above the allowance, every extra £1,000 earned is a step toward financial freedom. There really is no limit to what you can earn if you stay consistent, keep improving, and take smart financial steps in your side hustle journey. Do you remember the pop quiz question from earlier? I do, and I hope you got the answer right. If you selected A, there are less restrictions in accessing your money at any time, then you are right. It is worth remembering that funds invested in pensions in the UK cannot generally be accessed until the age of 55. Therefore, if you need regular access to these funds, it is not the best investment vehicle. After maxing out your ISA, the next steps can significantly boost your wealth. Increase pension contributions for tax relief and long-term growth. Use general investment accounts for flexible investing beyond ISAs, and explore investment bonds for tax-efficient withdrawals. Property offers strong returns through buy-to-let or REITs, while investing in yourself, whether through high-income skills or a side hustle, can unlock unlimited earning potential. The right strategy depends on your goals, but each step helps build long-term financial security. If you want to continue your More Money Monthly journey and learn more about personal finance, watch this video next.